Some were calling it a bear market rally. 23%, I think, on the S&P 500 from mid-June to mid-August, and now we're giving back. We thought one of the reasons for that rally was that the Fed was going to pivot, and that the market, seeing the deflation in the pipeline, assumed that the Fed would start talking about that deflation. Instead, we got Jackson Hole, and now the market's relapsing. We do think we're in a bottoming phase here, because we think we're going to see a lot of deflationary signals that will, at some point, get the Fed to talk about them. It doesn't want to talk too soon. It doesn't want to give anybody any indication that it's anywhere near pivoting. It wants to sound very hawkish. Wants everyone to believe that they're going to be as tough as Volcker was, in order to get to 2% faster than would otherwise be the case. You know, it could be a lot less than 3% if some of these big retailers start slashing, they need to, prices in order to clear the shelves and put in holiday merchandise. So we'll see in the next few months. As to markets now, so starting with equities, we've talked a little bit about that. As usual, equities are very dependent on a couple of things: profits and valuations. Now, we think profits are going to be hit hard here. More the cyclical part of the world. Our strategies are not biased cyclically. If anything, they're biased completely in the opposite direction. And they tend to do well when overall profit margins are coming down. Now, profits in the GDP accounts looked like, the early indications were that they were down significantly quarter to quarter in the second quarter. It seems as though they moved up to an all-time high. What I have found with these metrics around turning points, these metrics and especially employment, is the revisions. If we're really in recession, the revisions are extreme. If you listen to all of the companies reporting, you would not believe that profits are up. Many of them are down, and down in a very big way. So again, this dependence on economic indicators, which may be distorted by seasonal factors gone wild during COVID, and an inability to adjust them accordingly, could be distorting some of these numbers. The second variable, valuation, very dependent on interest rates, which in turn are dependent on inflation. And you know what we think. But the bears think we're going back to a 70s style inflation and valuations dropping to those levels. That is the essence of the fight taking place, this tug of war as we try to bottom up in the market, bottom out. I think watching prices, real-time indicators, supply relative to demand, is going to get us to the right answer faster. And right now, we'll go into it in a minute, those indicators are showing in some cases signs of collapse. So the interesting thing, and we are keeping in fixed income, we are keeping our eye on the 10-year. It peaked at 350 in mid-June, just about the time the stock market bottomed, and got down to 250. We went down 100 basis points by early August. We're back at 320 today, again, because of the Fed's hawkishness. So, you know, the short rates moving up and long rates kind of following, not quite as quickly. The yield curve still negative, not as negative as it was, but still negative, and that's important. So we believe longer term, if we're right on our deflation call, that we're going to get back to 2% long-term interest rates. And what's very interesting about that from a equity valuation point of view, I've been struck through my career, through all the period of disinflation, as they have called it, since 1981, until recently, that the market, the PE ratio of the S&P 500 could never really get above 20 to 25 times, even in the best of markets, the strongest of markets with the lowest inflation and so forth. And that's because there was this disbelief that inflation was really in the 1 to 2% range, where it was for quite a while. Most people thought the normalized, or it's not even inflation, it's GDP growth. Normalized GDP growth is 4 to 5%, most people think. Say 3%, 2 to 3% growth and 2 to 3% inflation. I just do a quick back of the envelope to try and figure out at different interest rates where the PE ratio should be. And historically, you go 1 over the interest rate. So P, this is for bonds, price, over E, earnings in the bond market. If we're at 3%, you just take the inverse of that. That's a 33 times multiple. Well, we've never gotten there. And that's because no one believed that inflation and interest rates truly were embedded in the system close to that 2 to 3% range. We do believe that, and we believe innovation is going to make sure that that's the case during the next 5 years. The only other 2 things I'd like to say about fixed income is high yield spreads are moving out again. Credit default swaps are moving out again after settling down, just like interest rates did. And credit default swaps are insurance policies against bankruptcies. And, you know, it is pretty amazing to watch a company like Bed Bath & Beyond. I hadn't looked at their financials in quite some time, as you probably can imagine. It's not something we would look at. But I think there might be some solvency questions there. That's why they are trying to restructure. And who would have thought Bed Bath & Beyond, sort of what we all need? Well, that's the disruption called online retail. In terms of commodity prices, just to give you what's in the hopper here, I think I've set this up from an inflation point of view before, but the best gauge of inflation I have found over my many years in the business is gold, the gold price. The gold price has been in a trading range for the past 2 years, more than 2 years now, and it hit almost 2,100 way back in August of 20. That's when it peaked. Made another run at it in March, failed, and any technician will tell you that's significant in terms of, okay, what is the trend here? Doesn't look like it's up. And now we're at the low end of the range, 1,700. And we think we're going to continue to break down as the dollar moves up. And and we begin to see, basically an increased shortage of dollars relative to demand relative to supply, a short supply, pushing the dollar up. That's called a flight to safety, and it's happening because the rest of the world's in a bit of a mess. Europe in recession, believe it or not. We think our energy prices are bad. If you convert the natural gas prices in Europe to the equivalent of oil prices, they're almost $400 a barrel. That's more than 4 times where we are right now, almost 5 times where we are here in the United States. So that's a cruel tax, to be sure. And we do think Europe's in recession. I think China's in recession. So the U.S. really is the swing factor here. On a year-over-year basis, gold prices are down 10%. Copper prices are down 21%. Lumber price had gone from $250 per unit of whatever sheath, and all the way to $1,700. Now they're back down to $486, and on a year-over-year basis, lumber prices are down. No wonder housing is in a world of hurt. Energy and food are the sticklers here. Again, Russia, Ukraine. Right now, oil prices on a year-over-year basis are up 19%. But if we stay around this level, given what happened last year to prices, we could be flat by November on a year-over-year basis. Corn today is up 24%. We know the drought and bad yields are contributing to the Ukrainian problem. We know crypto prices, they're down 60%, both Bitcoin and Ether on a year-over-year basis. And it is interesting that they're trying to stabilize in this range while other commodity prices continue to capitulate.